Please pause the video until you have done the court case and practice lab and compared your work to the answer sheet. Then you're ready to watch this part of the video where we'll talk about the interesting aspects of the court case. A good practice before you start looking at 2021 tax documents is to look at the 2020 tax return and get a good overview of what happened the prior year. In this case, the only thing that you see on the front side of the 1040 for 2020 tax year is some employment wages. But if you look a little bit further, you'd also have seen unemployment. For 2020, that wasn't taxable because the first $10,200 of unemployment income was excluded. So it isn't carried forward to the first page of the 1040. But based on that, you might expect that 2021 would have some wages for sure, and possibly some unemployment. When you were in the return, doing the personal information page, you should have considered whether to enter 2019 earned income. In this case, you didn't need to do that because Tom's income is high enough for 2021 that it's irrelevant what the 2019 earned income was. So to be specific, if you're familiar at all with earned income tax credit, the credit rises as your earned income increases up to a certain point, then it plateaus. Additional earned income doesn't change the credit. And then as earned income continues to increase, the credit decreases, eventually going down to zero. So what's of interest in using 2019 tax earned income is the point along the curve, along the hill, where an increase in earned income is still increasing the credit. Once you reach the point where at the plateau, you don't care. Those points are as follows. If the taxpayer has no qualifying dependents, then once the taxpayer has earned $9,820 in 2021, the 2019 income is irrelevant because it can't help. A higher 2019 income is simply going to push you along the plateau or past the plateau and starting down. So if the taxpayer had one qualifying dependent, the cutoff point is $10,640. And if the taxpayer had two qualifying dependents, the cutoff point is $14,950. Now, you don't need to write those down. They'll be in the duck book in the 2021 version. But as a rule of thumb, if the taxpayer has $15,000 or more of earned income in 2021, it's irrelevant what the 2019 income was, and you can skip this eighth box and keep moving. When you finished the basic information section, there are two things you want to consider, should have considered before you turn to the entering the tax documents: charitable contributions and the recovery rebate credit. The taxpayer said that he didn't make any charitable contributions, but he did have some EIPs, economic impact payments. So the menu on the federal section has a COVID-19 relief section and item, and you should have gone there. The taxpayer said he got two EIPs during 2021, $600 in January, which is actually part of the 2020 tax return, so it isn't entered here, and $1,400, which is what he was entitled to. And when you put that in here, it means that you will not be claiming on the tax return any recovery rebate credit. Let's take a look at the W-2. When you entered the EIN, 1307, etc., you probably had the computer fill the employer's name and address because this particular employer was already in the database with the EIN. That again is as similar to the 1099-Rs, is going to happen pretty commonly with common employers. The fact that Mark's computer repair shop is probably a small company, and It means it's unlikely that you would actually get that help from TaxSlayer, but could happen. The address information populates here from the personal information page. If that's wrong, for example, the taxpayer has moved, you need to change that information to match what's on the W-2. So now turning to the actual information, when you entered the information into box 1 wages, it would fill in boxes 3 and 5 automatically. In this case, that's correct. If it were not correct, you would need to manually change that. Box 2, boxes 4 and 6 are also populated automatically. Box 2 is not, and this is easy to miss and obviously pretty critical to put in the federal tax withheld. As a general rule of thumb, W-2s almost always have withholding. So what else do we have? Box 12, you enter DD, which is the coverage, healthcare insurance coverage provided by the employer of $4,300. It's probably a pretty inexpensive policy. And then the CASD, the California California State Disability Insurance, SDI, sometimes it'll appear on your W-2 as just SDI, always goes into box 14. And in fact, the first entry on there, the pre-populated pull-down entries, is in fact the California SDI. So that you put that there regardless of where it appears on the paper form. CASD is potentially useful as a medical expense, although in this particular case, the taxpayer is not itemizing, so this information doesn't impact the tax return at all. And then finally, down in the California section or the state section, you would enter the state name, the state. When you tab to the state EIN, TaxSlayer should automatically populate that in the same way it populated the address information for the employer. Be careful to give TaxSlayer a moment or two to fill this before you start typing, otherwise you'll end up with 16 digits instead of 8. And then you add the wages. Box 16 automatically populates. 17 you need to enter. That's also another place where people often miss the state tax wages. The final thing to note on this is you must enter California information in order for the return to be prepared correctly. So even if there isn't any California information on the W-2, that would be unlikely. You need to put it in. For the state EIN, you either enter 6 zeros or 6 nines. Box 16 equals box 1. Obviously, if there's no California information, there's no state tax withholding. So that completes your W-2. Here's the input form for the unemployment income. Not much to say here. The payer field is the standard payee number for the Employment Development Department of the state of California. So when you put that in, you're going to get the other information filled in automatically. There was no federal tax withheld. If there's a lot of unemployment, that's not a good decision. There wasn't very much in this particular case, so you don't need to chastise the taxpayer. That's the wrong word, of course. Suggest to the taxpayer that withholding would be a good idea. State information is not required on this form, and it's not been entered. That saves you time and the taxpayer time. The California 1099-G for unemployment actually has 2 sections. The first section is the normal unemployment, and the second section is family leave. You should always take a quick look at the form to make sure it doesn't have both types of income, because if you do see that, you have to put them in separately. And the way you do that is put in the first one, click continue to save it, and here on the grid, you can add an unemployment statement, and that's where you enter the information for the second part of the form. Since we don't have that, we're just canceling that here, and that brings us back to the grid, and that completes the unemployment issue. Now let's take a look at the 1099-R. Notice that even though taxable amount not determined was checked and total distribution was checked, which is sort of a contradiction, the box 2A was filled in. The Distribution code is 1. That's critical. That's an early distribution. That means because the taxpayer in this case is under the age of 59 and a half, there are penalties on the early withdrawal. Potential penalties, 10% federal and 2.5% California. And because there was no state withholding, there was state withholding, $106 in California, this section in the bottom half is required. There should have been, usually if there's state, there's federal. Yes, there was also federal withholding, so that information was entered. So after you put this information into the tax layer, you clicked on Continue, and you get this screen, which talks about the penalty. And this is a retirement plan, that's checked. It's not clear, quite frankly, what this box here, certain circumstances, does, because the form that you fill out, if there's any exception to the penalty, the 5329, does not depend on checking this box. If you check this box, you're not going to see that form. You have to go elsewhere for that. We'll talk about that in a moment. And if you don't check this box, you still don't go to the 5329. And if you do or don't check this box, it doesn't give you an error message. The software doesn't send you anywhere particular way. So it appears that theoretically this box would be checked if there was an exception. This taxpayer here doesn't have an exception. Again, we'll talk about those in a moment because it's important to find exceptions if you can, but there are none in this case as the case was laid out. So no reason to check that box and no reason to go to the 5329. You click on Continue. You get this page. This is, if you see the form, it's 8915E. That's actually last year's form. The form for 2021 is the 8915F. That form is in draft at this point, and TaxSlayer has not implemented as of today, December 23rd. So the answer here is no, there isn't a qualified disaster that allows the taxpayer to spread the distribution across multiple years, 3 years. I will note that when the 8915F comes out, it's probably going to have something similar to this. COVID-19 is not a disaster for 2021. You cannot use that as a reason to spread the taxable amount of an IRA distribution across 3 years. You have to have a federally declared disaster other than COVID-19. There actually were 2 wildfires in California that were federally declared disasters. They do qualify. However, spreading 2021 distributions across 3 years is out of scope for Tax-Aide. So you click on Continue here, and you have this grid form, and we're done with looking at the actual input for the 1099-R. But one final point. When you click on Continue and you save a form, you are saving it in servers in Georgia. The information does not reside on your personal computer, and if something goes wrong, your internet connection breaks, or some reason your computer crashes, and the Chromebooks that you'll be using during the tax season are very robust. If something goes wrong, then at most you will lose the form that you're working on. So you don't need to worry if something goes wrong, other than you'd like to get the connection back and continue working. Anytime you see a penalty for early distribution, you should automatically look at ways in which that penalty can be waived, because 10% plus federal plus 2.5% state penalty on top of regular taxes can take a bit of a bite. Pub 4012 is really good here. Starting on page H-4, there's a lot of information about the ways in which that penalty can be waived. It involves Form 5329, and the very first thing you'll see at the top of page H-4 is how to get to that form. You don't want to go there until you're sure it's usable. So Pub 4012 shows the form itself. Only sections 1 and 9 are in scope. Part 1 involves the waiver for early withdrawal on an IRA. And there's a bunch of codes. Some of them are described in some detail. I'm going to go down to the table that lists all of the codes that can be used. Tax-Aide doesn't actually use these codes. In the pull-down menu, they have a description. But I'm going to refer to them here because it's a little easier that way. So the ones that are of interest generally are Code 5, which is for unreimbursed medical expenses. However, this is subject to a 7.5% haircut, sometimes it's referred to, based on 7.5% of AGI. So somebody who had $20,000 of AGI would not be able to count the first $1,500 of unreimbursed medical expenses. Nevertheless, if they have some very high medical expenses, this could be usable. It doesn't really matter when during the tax year it was incurred. It could have been incurred before the distributions were made, just sometime during the tax year. Another one is health insurance premiums. 07. There's an interesting footnote there. One of the requirements is that the taxpayer has to have been unemployed for 12 consecutive weeks. But another point in that footnote mentions that it could have been the prior year, and the distributions have to occur no later than 60 days after the taxpayer becomes reemployed. Another one is qualified higher education expenses. And finally, I want to point out that there is an exception for the purchase of a new home, providing that the distribution was paid within the home was purchased within 120 days of the distribution. So, again, anytime you see a penalty for early distribution, ask the taxpayer why they'd had it. They may just say general expenses, and then see if any of these possible exceptions apply, because there's a lot of money involved and it doesn't take very long to go over these. This concludes the discussion of the core case for case number 2. Please pause the video until you've done tasks 5 through 7, that is, you've done the expanded case and you're ready to get some more feedback. As previously mentioned, when you finished putting information into the basic information section of Tax-Aide, there are 2 things you should take care of or consider before you turn to entering the tax documents. Those 2 are charitable contributions and the RRC. In the expanded case, the charitable contribution situation has changed. So let's deal with that first. So I mentioned a path that you can get to involving itemized deductions for entering the charitable contribution, but it turns out there is a second path. So let's go down that path instead. So on the deductions page, there is a CARES Act 2020 option. Rather than going to itemized deductions as we talked about before, you can click here. It's already there, so it's edit rather than begin. And this is essentially the override function that we talked about before. That's an option, a recommended option for entering contributions by check or credit card. So you should have entered $400. You could have entered $300, but there's no particular reason not to enter the actual dollar amount and let Tax-Aide handle what to do with any excess. It's $300 for single, $600 for married filing jointly as maximums, but again, Tax-Aide takes care of the excess. So now we're ready to turn to the new form for the expanded case. For the student loan interest form, it may have taken you a little bit of time to figure out that hiding under the deductions menu is the adjustments menu. When you click on that, you can see that if you scroll down here, There's one entry that involves an edit. You've been there. That's your student loan interest. And you click on Edit. And this obviously is a very simple form. I should say a simple entry. The only thing I want to mention here is that taxpayers will sometimes tell you they have made a payment of student loan interest without having the student loan interest form. And that's fine. You can enter that based on what the taxpayer tells you. However, be careful. This is not student loan payments. Student loan payments involve both principal and interest. This is only the interest portion of the student loan payments. So if the taxpayer tells you that she has paid $3,000 of student loan payments during the year, that's not the right number to put into this form. You need to figure out, the taxpayer needs to figure out how much the interest amount was. And often the taxpayer can go online and get that information. If not, and they want to take this deduction, which is worthwhile, they're going to have to come back with that information however they can get it. One final form, gambling winnings. That's a type of income. If you go to the income menu and scroll down, you find less common income. You can see by the edit here that that's where the entry has already been made. There's our gambling winnings, W Form 2G. And here's the entry for the Blue Lake Casino. So the information has been put in about the location of the casino. And here's your information, winning information. Federal tax withheld, that's very easy to miss, so don't miss it. Type of slots. There's a lot of other information here. The state information is not needed. Locality information is not needed. You really want to focus on things that are required, that's the red asterisk, or things that make a difference, such as federal tax withheld. Notice that gambling losses have been entered here. Gambling losses are limited to the amount of winnings that are listed on this form, or I should say generally, overall, you can't claim more losses than you can claim winnings. Unfortunately for the taxpayer here, the gambling losses are only useful if the taxpayer itemizes, and the taxpayer is not itemizing on this return. So essentially that adjustment, that gambling loss adjustment as part of itemization isn't going to make any difference. If we were to zero that out, the tax return wouldn't be changed in the slightest. That concludes the discussion of the expanded case for case number 2. Now let's turn to the 3 what-if questions in the student guide. Question 1. What if Tom had made a charitable contribution of stuff, donation of goods, rather than writing a check or making a credit card donation to Goodwill? Well, this is an easy question because the answer is that Tom wouldn't have been able to take that charitable contribution, the one that shows up on line 12B of the Form 1040, because you can't take that deduction for stuff. If Tom had itemized, if he had a whole bunch of things that improved his situation by itemizing rather than taking the standard deduction, then a charitable contribution in the form of stuff, goods, whatever, can in fact be useful. But in this particular case, the special provision, $300 single, $600 married, filing jointly for 2021, does not count the donation of things as opposed to money in the form of a check or credit card. Question number 2. What if Tom's parents had made his 2021 student loan payments instead of Tom? Can Tom still take the student loan interest deduction? This is a sort of issue that you should not spend time memorizing the answer. This is the kind of question where you go and look at the reference materials. So let's do that. Here's page E11 in the NTTC version of Pub 4012. And here is the critical paragraph that student-led interest is paid by somebody else. Payment is treated as received by the person, that's our taxpayer, who's legally liable, and the person legally liable, our taxpayer, is allowed to take the adjustment. And the Duck Book says, of course, the same thing, just worded a little differently. So even if payments are made by others, for tax purposes, the payments are treated as if they were made by the taxpayer. So bottom line, yes, Tom can still take the student loan interest deduction. Question 3. What if Tom brought in a bank statement that showed $3.53 of interest, but had not gotten a 1099 INT? Does that $3.53, rounded up to $4, need to be entered in the tax return? Well, the answer is yes. It's not surprising he didn't get a 1099 INT because that's not required to be issued unless the amount involved is $10 or more. The point is that interest is income. Income has to be declared. Income has to be entered into the tax return. And this is particularly true for income of self-employed people. There's a myth, if you will, a serious misunderstanding that if you're paid in cash or if you don't get a 1099 miscellaneous or a 1099 NEC, that you don't have to declare that income to the IRS. Well, that is a requirement, and our expectation is that clients will disclose that to us and that we will put it into TaxSlayer. We don't give them the third degree. We don't ask them to swear on a Bible. We don't push them hard if they don't want to tell us. But the question, we do ask them whether they had any cash income and approximately how much that was. So in this particular case, it's a long answer to a short question. The $3.53 needs to be put into TaxSlayer as if there were a 1099 INT. You use exactly the same screen. And no, the IRS won't be able to match this against their records because the bank hasn't reported this interest to the IRS. But the IRS is perfectly happy, the IRS computers are perfectly happy to have income show up that they are not aware of. This concludes case number 2 in the California Shared New Counselor Training Program. If you have any problems with the case, questions on how to prepare the tax return, please feel free to contact your support person, support volunteer in your district. You can also send feedback to the email address shown on the screen.